Hey everyone, welcome back to Corporate Decoder, the place where we decipher those dense financial reports, and today we're diving into CBI Group's latest quarterly update, looking at how they performed in the third quarter of 2025. Let's just say they've been busy and the numbers tell a pretty interesting story. Oh, and before we dive deep into the numbers, if you love getting these straightforward breakdowns of complex financial documents, do us a favor and hit that subscribe button. Also, we've got a fantastic community growing over on Discord. It is a great place to connect, ask questions, and share insights. You'll find the link right down in the description. Alright, starting with the big picture, CBRE reported a total revenue of over $10 billion for just the 3 months ending the 30th of September 2025. That is a pretty massive number. Looking at their balance sheet, total assets grew to about $28.6 billion, up from $24.4 billion at the end of 2024. That is a pretty significant jump, showing the company is expanding its holdings and investments. Digging into the revenue breakdown, their facilities management division brought in over $5 billion in just 3 months. That is their biggest revenue generator, showing how crucial ongoing building operations are for major companies. Project management is also a huge chunk, bringing in over $2 billion. This highlights the demand for managing complex construction and development projects, especially with global markets showing strength. Now, this is interesting. They reported a gain on disposition of real estate of $36 million in the third quarter of 2025, a nice boost compared to a small loss in the previous year. This means they likely sold off some properties at a profit, which is a good sign that their real estate investments are paying off. And the bottom line, net income attributable to CBRE Group Inc. Shareholders was $363 million for the quarter. That is a strong increase from $225 million in the same quarter last year, so they're definitely making more money. Looking at the longer 9-month picture, revenue climbed to nearly $29 billion compared to $25.4 billion in the prior year. That is a solid 14% increase, showing consistent growth. However, their cost of revenue, excluding pass-through costs, also went up significantly by about 15%. This means while they're making more money, their core expenses for delivering services are also rising, which is something to keep an eye on. Operating, administrative, and other expenses also rose by over 7%. While this is less than their revenue growth, it indicates that their overhead costs are climbing as well, likely due to expansion and integration activities. Let's break down their main business segments. Their advisory services segment reported an operating profit of $444 million, a nice jump from $359 million the previous year, showing their leasing and capital markets businesses are performing exceptionally well. The building operations and experience segment, which includes facilities and property management, is also doing great, bringing in $285 million profit for the quarter, up from $244 million. This segment is growing strong, indicating more companies are outsourcing their facility needs. Project management, including their Turner and Townsend operations, saw a profit of $153 million. This shows continued strength, particularly in places like the UK and the Middle East. The real estate investments segment, however, saw a slight decrease in profit to $73 million from $67 million last year. This segment often has more volatile results due to development cycles and investment returns. And what about their cash situation? As of the 30th of September 2025, they had over $1.8 billion in cash and cash equivalents, a healthy increase from about $1.1 billion at the end of 2024. This shows they have good liquidity, which is crucial for a company of this size. Now let's talk about debt. Their total long-term debt is around $4.4 billion, up from $3.3 billion at the end of 2024. This increase is largely due to new debt they've taken on, including senior notes and term loans, which they're using to finance growth and strategic moves. In May, they issued $600 million in senior notes with a 4.8% interest rate due in 2030, and another $500 million with a 5.5% rate due in 2035. They also mentioned redeeming their 4.875% notes that were due in 2026, showing they're actively managing their debt structure. Looking at a profitability metric that's not strictly GAAP but gives a good operational view, core EBITDA for the quarter was $821 million, up from $688 million last year. This indicates their underlying business operations are becoming more profitable. Now for my take, CBRE seems to be navigating the current economic landscape quite well. Their revenue is growing across most segments, and their acquisition strategy, like the full purchase of Industrious in early 2025, appears to be integrating successfully and boosting their building operations and experience segment. The growth in leasing and sales activity across their advisory services segment is a strong signal that demand for commercial real estate services is picking up. However, the increase in their cost of revenue and operating expenses, while expected with growth, does eat into margins. Companies like CBA often face pressure to maintain profitability as they scale. Their debt levels have also increased, and while they seem to be managing it well and have strong interest coverage, any significant downturn or further interest rate hikes could make servicing this debt more challenging. The real estate market can be cyclical, and CBRE's performance is closely tied to it. While they've shown resilience and growth, future economic shifts, global political uncertainty with trade policies and currency fluctuations, and even regulatory changes could impact their international operations. That said, their diversified segments and global reach offer some protection against regional downturns. Overall, CBRE appears to be in a solid position, demonstrating growth and profitability. Their strategic acquisitions and focus on key growth areas like facilities management and project management seem to be paying off. The company is actively managing its debt and showing a strong commitment to shareholder returns through their share repurchase program. We'll be watching closely to see how they continue to adapt to market dynamics and integrate new businesses. Alright, that is our breakdown of CBRE's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description to join the conversation. Thanks for watching, see you next time.